Hey guys, welcome to book 3 of Learning with Pro, and my name is Joseph. So this week we'll be talking about forex analysis, the types of forex analysis, and we're talking about technical analysis as our major study. We will be looking at types of charts, brief history of candlestick, trends, and support and resistance and trend reversal. Okay, what is forex analysis? Forex analysis is the study of determining whether to buy and sell or wait on a trade on trading pair. That means reports which give you clarification on the type of trade you should go on a currency pair. Maybe you should go on a buy, or you should go on a sell, or maybe the buy you should go on is very long for a long period of time, or the sell is it for a short period of time. So that's what forex analysis is talking about. That is the study of determining whether to buy or sell or wait and trade in a currency pair. Now, types of analysis. We have the technical analysis, we have fundamental analysis, and we have sentiment analysis. Now, sentiment analysis is more of a blend of technical and fundamental analysis. That's why if you search for types of analysis, forex analysis, they will only give you technical and fundamental analysis. Fundamental analysis are the major forms of types of analysis. But as a forex analyst, you must be able to use technical and fundamental and sentimental. That means when we're using two of them together, that means you must be good in technical analysis and fundamental analysis. Now moving on to what technical and fundamental analysis is. Technical analysis is a range of techniques used to try and forecast future price movement of financial products based on historical price movement and pattern. Now, foreign exchange markets are particularly well suited to using technical analysis. Why? Because it's just show you maybe you should buy the product or sell the product. Fundamental also do that, but fundamental will show you reason why. There is a difference between fundamental will show you reason why you should buy the product and sell it. But technical analysis will just show you that okay, is this product will be going up or going down by using our techniques, maybe candlestick patterns, price action patterns, harmonic parcel, you have a lot of they have different forms and reason of indicator, maybe moving average, Satoshi. You have many types of indicators in the market. But it's just to show you, okay, is this market going on a buy or a sell? That's if you can get this, that's the difference between technical and fundamental. Technical will just show you the view of the market, but fundamental will show you the reason why it will go that way. You have to understand that. That's to put it in the layman form. So you can be able to understand the difference between technical and fundamental, because they are almost the same thing. But fundamental gives more about the reason. Okay, at this particular time, what makes this price to fall? All this technical with the technical analysis don't know those stuff. Okay, you don't agree. Price for here. Okay, so that means if price gets to the same level again, you see that it's going to fall, things like that. You are not looking at why is the reason why price fall at a particular time. Like for instance, the way the Silicon Valley going down in the United States. If you notice, United States currency crash. If you are trading every pair related to United States, even audio currency pair affected audio currency pair. It's even got to Bitcoin. It affected Bitcoin. For you to know how they can affect each other, it affected Bitcoin, it affected a lot of cryptocurrency. So something like that now, if it's a technical analysis, you just look at okay, there's a price, there's a fall in it, okay, how will I make money from it? But fundamental analysis, you look at okay, what makes this particular price to fall? You now begin to do research. You begin to do research. And look at the definition of fundamental analysis. Fundamental analysis is based on the idea that each asset has a fair value, and that's why the market may temporarily overpriced or underpriced an asset. Eventually, each price should normalize to that fair value. Say you analyze a company and decide that is worth more than its current price, share price. So, what is sentimental? A sentimental is a measure of how trade and investors view the outlook of the market and larger economy. Forex trader can use technical sentiment indicator to help identify entry exit points for currency pair trade. These include COT reports, open interest, and broker position summaries. Now moving on to technical analysis, because I've explained what technical analysis, fundamental analysis, and sentimental analysis. Now moving on to technical analysis. Technical analysis is based on three philosophy. One, market action discounts everything. That means the view of the market chart shows you everything where the market will be going to. Maybe is it a buy or a sell? Will it go for a long period of time or for a short period of time? It will show you everything. It will show you everything. And the second one is price moving trend. Price moving trend, there are three types of trend. Three types of trend in market, and that's when price will move. It's either price is in a uptrend, that is a buy, or price is in a downtrend, or price is in a sideways trend. We call it sideways trend. I will still talk more of that later on in the class. We'll talk about trends because price moves in trend. Now, history. Third one, history repeats itself. History repeats itself mostly in forex. That's why we look for key level. That's where the support and resistance comes in. Because we deal more with history and doing a technical analysis. Because by you placing, okay, let's say for instance, at a particular price of $100,000 USD forex, at a particular price of $100,000. Now, USD now is at $900. Like after 3 weeks, USD now is at $900. Now $900 going to that $100,000. You know, there's a possibility that if it touches that $100,000, it will fall. You know why? Because something happened in the previous 100,000 that makes it to fall at that particular price level. There was something that happened there. But that is the work of the fundamental analysis. That's why I say, as the forex analyst, you must be able to do your analysis by fundamental research and technical research. You must be able to use the two of them, that is sentimental analysis. You must be able to blend the two of them together. You must be able to blend the two of them together. Because as this fundamental research now, when you see price at that particular price, you have to go there, okay, what happened there? What makes this price to fall? Because there will be something, there is no how. There will be something that makes price to fall something like that 100,000. So that means if price gets to that place again, there is a like 70% of chance that it will fall again. That's why I said history repeats itself. When we begin to show more on trade, if you don't begin to trade more of our account, you will see. It's what I'm talking about. That history repeats itself. I will show you very, very clear example. Now, difference between technical analysis and fundamental analysis. Now, technical analysis focus on the study and past performance of price market action. Fundamental analysis concentrates on the fundamental reason that make an impact on the market direction. The purpose of both of these methods is an attempt to forecast and determine the future price movement. The difference is based on how they achieve that objective. Now, fundamentalists study the cause of price movement, whereas technicians study the result. As we have mentioned above, technicians do not find it necessary to know the reasons of market exchange. I've explained all this. But fundamentalists try to discover why. Therefore, technicians are also called chassis and interested in the price movement. They try to understand and study the emotion in the market, The second distinctive factor for the two types of analysis is the time horizon. Now, I want you to look carefully at this. Technical analysis takes considerably short time to analyze the market compared to fundamental analysis. Technicians do their research based on daily, weekly, and monthly data. But when you are dealing with fundamental, they look of data. They look at data over the years, maybe 10 years, maybe 5 years. Look at data over the years. Since each of those approaches take different time frame, they are applied for reaching different trading and investment goals. Generally, technical analysis is used for trade, while fundamental analysis is appropriate for investment purpose. That's due to most of the long-term trade. Trader buy an asset in the hope that later will rise in value and they will be able to sell it at higher price. The reason why fundamental analysis use so long time frame is following. The data they are generating much more slowly than the price, and the follow data used by the technician and technical analysis. After the result of that, fundamental analysis, for them to get those research, know that time is not waiting for them. Time is not waiting for them, and the price is still moving every day. So they take more time in dealing with price, in getting their research, because they will have to go to the currency. That means, okay, let's, for instance, they are looking at US USD. You have to now study about the US USD, the government backing the US USD, the nations, what happened to their countries. We're looking at the countries, and we're looking at what happened to the country. Are there inflation in the country? What is the open interest of US USD? We'll be looking at what is the gross domestic profit of the country, that is the GDP. We'll be looking at employment rate, we'll be looking at poverty rate, we'll be looking at different things in the country. We'll be looking at the CBN value, we'll be looking at different things, we'll be looking at the import and exporting, to just consider price, to study about the country very well. So, with all that, it takes time. This study takes time, but it generates a large amount of profit, because most of it's being used for investment purpose. And with this technical analysis, you can deal with stocks. Because these are all stock. That's why if you are studying stock, most of the thing that you do in stock is more of fundamental analysis. That's what they do mostly first. They use technical analysis, but a little. Reason why? Because fundamental stock is majorly based on fundamental analysis, because you have to study about the company. The company shares you are buying, you have to study about it. Although to show you price action, but you studying about it will bet a lot of things, because technical analysts may fail. Let's say, for instance, a company just went backwards suddenly. You know that it has affected the technical analysis automatically, has affected it. So let's say you, as a technical analyst, with your technical analysis, you are looking at a buy position, and you open a buy position there, and the company just went backwards. You know, it's automatically going to put you in a sell position. That means you're already in a loss position. That's where you have to understand types of currency you are trading, and the types, maybe stocks or crypto. You have to understand the market you are trading very, very well. You have to understand the market you are trading very well. That's why you have to be good in both fundamental and technical. That's my advice for you, to be good in both of them. Don't put one of them over the other. Now, types of charts. There are basically many types of charts, but majorly we use 3 different types of charts, which are line charts, bar chart, and candlestick chart. Now, line chart. What is line chart? In line chart, each and every price point is represented as a dot. The x-axis represent the time scale, and the y-axis represent the price. Each dot or points will represent the closing and the closing price at the end of the unit of the time, Those points are then formed to form a line. This is the simplest form of chart, but this is quite good if you want to plot 3 to 4 similarly priced stock in a single chart and compare. Moreover, the line chart gives clear idea about price direction of the stock. This line chart, when we'll be using it most, is mostly price action. When we're doing about price action, price action. So we'll still talk a lot about chart, line chart because we'll still use it. Now moving on to bar chart. Bar chart is comprised of a series of bar. Every bar has four important price coverage. We have the open, close, high and low. I will still talk about this because candlestick patterns also have open, close, high and low. Now moving on, the bars are represented in green or blue. When close is higher than open, and green or blue when close is higher than opening, and red color when the close is lower than opening. The bar chart are more detailed than the line chart and are good for demonstrating or spotting the classical price pattern. We'll discuss about the classical chart pattern in appropriate time. Now moving on to candlestick. Candlestick is a visual tool that depicts fluctuation in an asset past and current price. The candle has three parts. You have the upper shadow, the red body, and the lower shadow. Stock market analysts and traders use this tool to anticipate future movement in an asset price. I want you to understand something about candlestick and bar chart. They are almost the same thing. For instance, candlestick we deal with body. Bar chart don't have body, but bar chart has the four important parts of a candlestick, which is the open, close, the highs and low. Because candlestick have an open, close, highs and low, and we'll be talking more of it later on.